This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Rob, welcome back to the show. Honored to have you on. You've become an expert in this field, and man, you've written another book on it. Also, looking forward to diving into that. And what I love too about both your books is that it's like short and to the point. It's like, tell me what I need to know and tell me the helpful things that I need to know and kind of have under my belt before I start to raise money or start to structure a deal or start to think about what that should look like. And so, welcome back.
Yeah, great to be here. Excited about this conversation.
Yeah, me as well. Give us a little bit about the book and maybe what prompted this book, and give the listeners a little bit about, hey, what they're going to get to learn from the book as well, because I know it's going to be important. I wish I had books like that 5 years ago, right? Trying to figure out some of this stuff, but give them a little insight.
Yeah, well, your point is exactly right. You and I both wish we had straight to the point books like this when we were first learning these aspects of the business, which the first book, for those that aren't familiar, was about multifamily underwriting, which is a really critical process in the business. And then this newest book here is structuring and raising debt and equity for real estate. And this is a meaty topic, but somehow is able to still condense it in just over 100 pages.
That's impressive, by the way.
Thank you very much. Yeah. So it's a passionate topic of mine because deal structure is nuanced. You can make it as simple or as complicated as you like. And it really is one of the key factors to a good deal. The way I see it is a good deal is the right price, the right structure, and the right execution. So it's one of the three pillars. And honestly, the reason why I wrote it was just simply to follow up on the first book. I felt like that the first book was something that I really wanted to do because it was a gap in the market. There was no book out there that was just a straightforward guide on underwriting. So that turned out to be a really big success, and it resonated in that niche market. Obviously, not everyone's running to read a technical, boring book about underwriting, but for those that liked it, they really liked it. And so I really wanted to follow up with another really impactful book. So that was the real impetus to write it. And I felt it was a natural progression to add this deal structure topic on top of underwriting because they are connected, but it's also the second step, right? After you underwrite a deal, you really need to have the proper deal structure and ability to actually raise the capital on the debt and the equity side to close.
Speak to how much experience do I need to be able to understand the book?
So that is, I'd say, the biggest complaint, if there's any, about the two books I've written thus far, is that it is not necessarily for a beginner. And I feel like at the end of the day, it's still very accessible to a beginner, but it's just you're going to be having to look up certain definitions and concepts because I unfortunately don't take the time to explain everything. So I'm writing it kind of assuming that the reader is already in the space and involved and has some familiarity with the concepts, which that's just my writing style. And for me, that's just what I'm passionate about. I like to talk at that level. So sometimes I forget or just don't, it's harder for me to go and explain the simpler concepts.
Rob, why don't you give us maybe an example of just deal structuring? Like, why is this important? Kind of high level. And then over the next topic or so, we'll dive in a little more. But at least to begin the listeners with, like, why structuring the deal correctly or the best possible scenario? Why is that important? Are they not all this? I mean, obviously, I know this, but I want the listeners to know from you, like, are they not mostly the same? I mean, we all hear very similar structures often, but what all does that include when we're talking about the structure of the deal?
Yeah, so primarily we're talking about debt and equity. And so focusing on debt first, debt is one of the most important parts of your deal because in my opinion, it's the largest source of risk. So you could buy a property at a great price and you can have a great business plan, but if you finance it incorrectly, you may be setting yourself up for a downside scenario that you are not willing to accept. And so you need to understand the implications of the debt that you're using and the risk factors of debt, which we'll get into more in later series, are the interest rate, the leverage, and the maturity or the length of the debt. And, those are fairly simple points, but they all have a role in determining how much risk you're taking with your debt. And more debt or less debt is not necessarily always the right answer. And again, it depends on the deal. It depends on the investment goals. And that's why it takes a little bit of nuance and understanding to figure out, okay, this is the right amount of leverage because this is the sweet spot where we can still get better returns, enhance returns through the debt, but yet we're not putting ourselves into a certain risk territory that we're not comfortable with. So that is the first thing. There's a lot of variation on debt as far as fixed rate versus floating rate, short-term debt versus long-term debt, recourse versus non-recourse, and other bells and whistles that you're going to want to be aware of as you go into your deal. And this is true whether you're on the passive side or the active side. Certainly you'd hope that you'd have a good understanding of this as an active investor, but as a passive investor, you want to be familiar at least with these concepts. So that way, when you're presented with a deal opportunity, you know what you're getting into. You don't want to be surprised.
Yeah. One thing I meant to ask you as well, especially with the series of books, should we read the first one first? Is that important that before we read the structure, about structuring, should we read about underwriting first?
That's a good question. Actually, nobody's asked that yet. It's not mandatory. I don't think it's necessary. I'll say it was written with that kind of idea in mind, right? First step is underwriting. The next step is putting the deal together, but they are completely separate topics. So they can be totally read on their own.
Complementary as well, though.
Definitely.
Yeah. Helpful to understand both. No doubt about it. What about any actionable just advice that comes from the book that a listener can expect, as they read, or maybe, as they're looking at a project now? Is it too late to read the book if we've already got a deal under contract?
Interesting. Well, if you already have a deal under contract, it may make sense just to brush up on those different debt concepts that we just covered and debt options, just to sanity check your deal and see, okay, are we using the right debt with the right terms? Have we negotiated the right deal, or are we leaving money on the table by not pushing certain buttons on the lender's term sheet to get ourselves the best deal? And it can be non-economic. There are certain things that you want to be aware of that you want to negotiate for, such as, getting really into the weeds, I talk about lockbox accounts in the book. And I talk about how a lender will sometimes require you to funnel your rents into a separate account that you don't control. And obviously you don't want that. It's costly and it is burdensome on your asset management team. So to the extent that you can recognize that ahead of time and negotiate that early up front, you can possibly get that removed from the terms of the deal. So yeah, I think if you're under contract, there's still some things you get out of the book to make sure that the deal is good. And on the equity side, it's never too late to just double check to see if your deal structure is in line with the market. Everybody's syndication structure or equity structure may differ a little bit, but in my opinion, you don't want to differ too much away from the market, because standing out can just be negative. Even if you're too cheap, it can still be perceived as a negative, because people think, oh, well, this person is offering their deal at a really cheap deal structure, cheap fees or cheap waterfall. Something must be wrong here. So making sure that your deal structure is in line with the market, I think, is important as well.
Yeah, that's awesome. It's like we know it's so important who we surround ourselves with. And I think you could really niche down even on that. It's like guys who are really good at structuring or underwriting deals, right? If you want to be good at that, you need to be around those people. Is there any way you've done that? It's like get around, I don't know if there's masterminds that are just focused on that, but any way that you've been hyper focused on this topic?
Yeah, I think one thing I forgot to mention from the previous question was a desire. And so I've always had a desire to understand these concepts at a deep level, and having that desire and that intellectual curiosity has led me down the path of reading boring papers by lawyers, because deal structure gets down to to legalese. And so you need to understand the nuances, and same goes for IRR calculations and how XIRR in Excel is calculated and what the nuances there and what the downfalls are and things like that. So I have papers and articles from attorneys saved that I've read multiple times. So that desire and intellectual curiosity has led to that better understanding. And then now, as far as relationships, I think it also comes down to desire. Do you desire to have those relationships and have those conversations with those types of people? And so that's certainly been the case for myself and our team. And so we have continued to seek out relationships with, quote, institutional investors or larger funds and family offices, when I know that a lot of people in our industry kind of shy away from those sorts of groups because they feel like they are too expensive or they take too much control in a deal and things like that. So they actually want to avoid those types of big savvy investors. But that hasn't been us. We've welcomed it and gone in the other direction. So in the book, I also talk about on the equity side and specifically on the raising equity side, I talk about institutional investors and how to build those relationships and what that looks like.
Yeah. Awesome. If we're talking about deal structure, let's elaborate a little deeper. Like, what does that mean and why should the listener care?
So we're specifically talking about capital structure, and your capital structure is usually made up of debt and equity. And those are the broad categories, but inside both of those categories, there's a lot of nuance and a lot of different structures and products. So that's your entire capital stack. And we will certainly dive in and go deeper on all those fronts. And then as far as why it's important, I mentioned this on the last one, I'll mention it again. In my opinion, debt is your number one source of risk in a real estate deal. And I would guess something around 98% of real estate deals include debt in one shape or another. So it is in your best interest to be well versed in the nuances of it and why it is the riskiest part of the deal and what are the attributors to that risk. And then on the equity side, as a passive investor, you want to make sure that you're investing in an equitable deal structure. And on the sponsor side, you want to make sure that your deal structure is actually attracting investors rather than scaring them off. So it's important to make sure that there's a nice balance in the middle there.
Yeah, that's awesome. A debt and equity. Well, since debt is the riskiest source, help us to think through that. Why is it the riskiest?
Yeah. So the number one concern, or at least our number one concern when investing, is preservation of capital. Now, what does that really mean? Well, that means we want to avoid a permanent loss of capital. It's okay if we have a temporary decline in value of the property. That's okay. It's okay for the property to go down in value because we don't necessarily have to sell at that point in time when it goes down in value. But what we must avoid is being forced to sell when we don't want to in a down market. And that is often debt related. And then number two, even worse, we don't want to be foreclosed on by the lender and lose the asset completely. So those are the number one concerns and things to avoid. Now, you could just say, well, to avoid that, you just don't take any debt, right? And that is not very realistic for most deals. And the reason for that is because if you're trying to buy a $20 million deal, that's $20 million of equity if you don't use any debt. That's not very realistic. But even more importantly, the returns don't look very attractive. Real estate is a business built on debt, and unlevered returns, which means no debt involved, is not an attractive return profile for investors to invest in. So they just won't invest. So there's this balance that needs to be played of using debt to enhance the returns, but not going too far to create undue risk. And we briefly touched on it in the last segment, but we'll dive in now as far as the key metrics, which are leverage, interest rate, and term. So starting with leverage, that's probably the most important one. If you have higher leverage, then your returns on paper go up, but your risk in reality goes up as well. And the less leverage you use, then your returns don't look as great, but you're setting yourself up for more success and less of a bumpy ride when you're actually going through the deal. So finding that sweet spot is really important. And there's a few ways that we approach that with metrics such as loan to value, loan to cost, debt service coverage ratio. And then we also do some stress tests and sensitivity analyses. So that's more of an underwriting conversation, going back to my first book about drilling into the numbers and figuring it out. But the high level concept that we're talking about today is just leverage and the structure of it. Do you want to have high leverage, low leverage, short-term debt, long-term debt, and things like that?
You mentioned agency debt, turn into banks, bridge debt, bridge loans. Also, you briefly mentioned, what about recourse? So, obviously agencies typically non-recourse, but if you go to banks, are you okay with recourse? How do you feel about that as we think about debt?
Generally speaking, we are not okay with recourse. And I think we're in line with much of the market which is to avoid recourse as much as possible. And we've had some interesting situations this year where lenders have, I don't want to say anything negative, but have essentially retraded us. And that's a bad word in our business. And retrading means basically changing terms on somebody without a real good reason at the last minute. It's a different thing where if you're a buyer and you do your homework and you find something wrong with the property and you say, hey, I need a $2 million discount on the price because I found these things, right? That's not really a retrade because it was out of the buyer's control. But if the lender just simply goes, you know what, I'm getting kind of nervous about this economy, I'm just going to ask you to provide a recourse guarantee. That's a bit of a retrade. So we actually did have that happen to us, and we had not really any other choice. You know, when you are at the last minute with a deal, you're deep in escrow and the seller is expecting you to close, you need to make that move happen. So unfortunately we did, and we made the necessary things happen in order to amend the loan and provide a partial recourse guarantee. So that's not something that we are happy with, but in these times, there are certain measures like considering recourse in order to get better deals done.
And they know they got you at that point. You're going to do it, right? I mean, you believe it. Hopefully you believe in the deal.
Oh yeah, absolutely. And also you bring up a good point, right? They kind of have you in a position where you have to do it, but what does that say about the long-term relationship?
Yeah. Would you just at a high level too, so that, you know, I know all the listeners understand too, you talked about preferred equity, gap financing, mezz debt, even the participating part, just at a high level, when would we see those come into play, or maybe what that is at a high level as well?
Yeah. So what they are at a high level, mezzanine debt and preferred equity really are the same economic concept. They're just structured differently from a legal standpoint. So mezzanine debt is financing provided outside of the org chart or outside of the operating agreement of the deal, whereas preferred equity is technically not structured as a loan. It's structured as an owner in the LLC with preferential rights. So instead of a maturity date with a mezzanine loan where they actually have collateral that they can foreclose on, if you actually are inside of the org chart with your preferred equity position, you have a redemption date and you have maybe the right to remove the manager and certain major decision rights inside of the operating agreement. But functionally, they are equivalent in that they are providing subordinate debt to the senior loan at a higher interest rate. And there's some flexibility also. The interest doesn't have to be paid solely monthly. A portion of it can accrue. And that provides the borrower flexibility where if they can't make the full 13% payment every single month, maybe they can make 8% payments every single month. And then the remaining 5% can accrue every single month until the borrower is ready to finally pay off the preferred equity in, you know, a year or 3 with a new loan or a sale.
What about just some preferred structures that you kind of stick to or move towards, or are there, or is it completely based on what's available or the market or the deal? Do you kind of tend to go towards some specific ways, or?
Yeah, we have our preferences, but this is one thing that I love so much about our business is that it's so dynamic. Today, we find ourselves in this market, which has a very difficult and complicated, I don't want to say complicated, but it's just a very difficult time to obtain financing, right? But less than a year ago, it was wild and every lender was fighting to give you a loan at the best rates and everything. So you're always in a different environment, which causes you to need to strategically evaluate the situation and pivot if necessary. But for us, we're evolving and we're learning different things as we go through these experiences. But what we like to do is try to keep things as simple as possible. So my preference is if the deal can work without preferred equity and without different bells and whistles, then I would prefer it. I would prefer just to have a simple senior loan that is conservative at a fixed rate. And on the equity side, we try to keep things as consistent as possible, which I know we haven't spent time talking about equity, but our equity structure doesn't change deal by deal. We keep it very consistent with an 8% preferred return and a 30% promote up to a 15% IRR and a 50-50 thereafter. That's our base waterfall, and we don't make a habit of changing it. We do, however, have a major investor share class, which has a higher preferred return of 9% and no 50-50 split involved in the structure. So we offer major investors investing $500,000 or more a better structure. And then beyond that, we may have larger investors or fund-to-fund managers that are coming in for $1 million, $5 million, $10 million. And at that point, we will have a side letter agreement that will design potentially a whole new deal structure kind of from scratch. So that still gives us the flexibility to have our base structure for the deal and then be able to cater to our larger investors who kind of require preferential treatment.
Dive into the equity structure piece a little bit. What does that mean? You mentioned y'all don't change it, but I wondered if that is like all the time, or is it you stick to that, or how you, yeah, just deal by deal. You have to be able to have this return, or you just don't do the deal. What does that look like? And maybe dive a little higher level too on what equity is, and then let's dive deeper.
Yeah, you bring up an interesting point. So I know when you're looking at deals, and obviously it's hard to find a good one, it's tempting to say, well, you know what if we just make our deal structure a little bit discounted and take a lower promote so that our investors can get a higher return because these numbers are tight, right? It can be tempting to do that, but in the end, I don't think it serves you because you're basically buying into deals that are thinner and tighter, and you're also selling yourself short and not giving yourself the full compensation that you believe you deserve. So I don't like the idea of trying to stretch the deal structure to make a deal work. So that's one reason to keep the numbers consistent. So that way we know we're looking at deals the same way across all the deals we're looking at, and we can really identify the best opportunities. Now, the next piece is there's really kind of two styles of deals. There's a syndication, which is when you have many investors, and the sponsor, since there's many investors, the sponsor more so runs the show because each individual investor doesn't have as much power because they might be only investing 1% of the total deal. So in that case, the sponsor has to establish a deal structure and say, well, here's the PPM, here's the operating agreement, and here's the deal structure. So there's not really a negotiation, not really a back and forth. Investor can essentially take it or leave it. Maybe if they're big enough, they can approach the sponsor and ask about doing a side letter or having some sort of preferential treatment or different structure, right? So that's one style of deal. Now, the next style of deal is a joint venture. And in a joint venture scenario, that's where you have a single investor who's very large, usually somewhere around 80 to 90% of the entire deal. And in those cases, it's not the sponsor that proposes the deal structure. It's actually the equity. So the equity says, okay, yeah, we like this deal, and here are the terms that we work with, and they drive the bus. They really are the determiners of the deal structure. So it's interesting how you have two different scenarios. In one, the sponsor determines the structure, and in one, the equity determines the structure. But it's in the JV, there is a negotiation. You can absolutely negotiate equity structure at that point. But like I said, in a syndication, it would be somewhat odd to negotiate on deal structure, right?
For sure.
Yeah, so we have experience in both deal types. And obviously, when the equity is proposing the deal structure, then we can't keep our deal structure the same every time, right? Its starting point is theirs, and then we negotiate from there. We try to get to an equitable middle that we feel comfortable with. So hopefully that is somewhat helpful as far as how we approach deal structure. It's not like we're rigid in saying, well, no, we'll only partner with you if you abide by our terms.
Yeah, I think joint ventures aren't thought about often when we're thinking about doing a $30-50 million project, but it's going to depend on that investor, right? You mentioned, that investors are going to have 80 to 90%. Where's the other 10 or 20% going to come from in that model?
Yeah, great question. So I actually go into great detail in the book about this because it's a little bit of a sore spot for me. So the funny thing is, with a traditional joint venture partner, you have, let's say, they're putting up 90% of the equity. And let's say it's a $10 million equity check. So they'll put up 9 million, and then you have to bring the rest. You have to bring $1 million to the deal. And the way I break it down in the book is I say there are 4 different types of joint venture equity partners when it comes to this 10% equity requirement. So the most strict is they want you to have that 10% come from your own pocket. So the principals of the sponsor or the operator has to come from your pocket. And even in the most strict scenario, they want it to be net of the acquisition fee. So they actually dock the acquisition fee against counting towards your investment into the deal. And this to me is a little bit bizarre because I'm just not rich like that. I don't have millions of dollars to invest in every single deal. This is not the only deal I'm doing the entire year. So I feel like there's a little bit of a disconnect when it comes to those really rigid requirements.
So what you're saying, I just want to make sure myself and the listeners understand here. So you said, they're requiring this $1 million to come from you. If your acquisition fee was, let's say, $500,000 from the deal, it's just random, but let's say it's $500,000, then they're going to say, okay, you need 1.5.
Yes.
Yeah. Okay. Yeah. So they're not going to say you need $500,000 because you're going to get $500,000 acquisition fee.
Right.
They're going to say 1.5 to ensure it's all coming out of your pocket versus you're counting on the acquisition fee to make it happen.
Yeah. And I mean, totally understand where they're coming from. Skin in the game is really important, but I think it's just a little bit short-sighted for them to expect that a sponsor is able to make that commitment for all the deals they're doing throughout the year and beyond. So that is the most rigid scenario. I don't see it all that often, but when I do see it, I do honestly scratch my head because I don't think everybody is playing by those rules. And to be honest, I really think that in those scenarios, someone is doing some lying. There's some lying going on. There's something happening behind the scenes.
Yeah.
Now, the next kind of less strict requirement would be when the equity partner says, okay, it can come from your pocket or from your close family and friends, right? They want to know that, well, if your grandma's investing, you're still very committed to the deal, right? It's maybe even more important than your own pocket. So that is more flexible and more understanding. Now, the next step would be them not really caring where it comes from at all. And at that point, you basically have a mini syndication inside your joint venture where you can take your $1 million obligation and you can go out and do a syndication, and you can go to your private investors and you can raise, $50,000 or $100,000 each and go and get 10, 20 investors and pull them into your $1 million co-invest. And now you've got yourself a nice joint venture. And so that is a really good way to do big deals, right? You can raise your piece, go get the big joint venture piece, and now you're buying 20, 30, 40, $50 million deals.
Rob, anything else as far as the debt, the equity, anything else that, hey, I really want the listeners to know this. It's important to take this away.
Yeah, one piece that we'll just touch on is the actual raising part of the business. Right. We talked a lot about structure, but big, really important piece is actually going out and raising it. And it's both for debt and equity. And it's important to have relationships on the debt side to be able to go out and effectively raise the debt. And then on the equity side, you and a lot of other people in the space really spend a lot of time focusing and becoming experts in raising capital on the equity side. And so that's a really broad topic. So the focus of my book is not to reinvent the wheel as far as how to find investors and build relationships and things like that. But I do provide some unique insights on that front, both on the retail investor side, which, are essentially high net worth individuals that are not real estate professionals. And then also on the institutional side, I talk about how to find and interact and build relationships with these joint venture equity partners, which include family offices and private equity firms that can really be a great way to scale your business.
Rob, again, grateful for your time and being willing to spend this much time with us and dive into some of these topics I feel also are very important as far as when you're looking at projects like this and taking so many investors in a deal, so much capital, right? I mean, even if it was a duplex, I still want to know I've got it structured the best I possibly can, right? Even more so when we're talking about $30, $50 million project or bigger. So thank you again. Tell listeners how they can get in touch with you, learn more about you, and find the book.
Absolutely. So you can grab a copy of the book at structuringandraising.com. And if you want to learn more about myself and what we're doing at Lone Star Capital, you can go to our website, lscre.com.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.